I'm going to show you the exact strategy that could turn $7,000 a year into a $1 million portfolio completely tax-free by using your TFSA and RRSP. Let's start with your TFSA, the tax-free savings account that is a game changer for building wealth because every dollar your investments earn is completely tax-free. In 2025 and 2026, the annual TFSA contribution limit has increased to $7,000. And if you've been eligible since 2009 launch without contributing, your total room has grown to an impressive $102,000 as of filming this video. Here's where it gets exciting. Let's say you're 19 years old right now with $0 in your TFSA. If you invest $7,000 annually for 30 years with a conservative 8 to 9% average return from diversified Canadian and international ETFs, you could potentially have between $1.4 and $1.7 million by the age of 49, completely tax-free. If markets perform closer to optimistic historical US averages of 10%, you could potentially reach $2.1 million, though this would require sustained high growth that isn't guaranteed. But here's what most Canadians don't know that could cost you thousands. If you contribute even more than $1, then your limit, you'll pay 1% penalty per month on the entire excess amount. Unlike RRSPs, which have a $2,000 buffer, TFSAs have no buffer at all. For example, if you accidentally overcontribute by $5,000, you'll pay $50 per month until you withdraw it. That's $5,000 times 1%, not just the amount over $2,000. Even worse, in 2025, the CRA's My Account system has been experiencing delays in updating contribution room information, meaning you could be flying blind when making contributions. So how do you protect yourself? First, keep meticulous records of all the contributions and withdrawals. Second, remember that withdrawals only add back to your contribution room on January 1st of the following year, not immediately. Third, when in doubt, contribute less rather than risk penalties. And finally, consider calling the CRA's tax information phone service at 1-800-267-6999 if My Account shows outdated information. But here's another massive trap that could destroy your TFSA's tax-free status completely: over trading. The CRA can flag your TFSA for carrying on a business. And if they determine you're day trading or trading too frequently, they can deem all your profits as taxable business income. There's no clear definition of what constitutes overtrading, but the CRA looks at factors like frequency of transactions, your expertise level, time spent on trading, and whether you hold investments for income or capital gains. Some people have been hit with massive tax bills on their entire TFSA gains because they were deemed to be running a trading business. The safest approach is to treat your TFSA like a long-term investment account, not a day trading platform. Buy quality ETFs or stocks and hold them for years, not days or weeks. Now here's the crucial detail most Canadians miss about US investments. While the TFSA shields you from Canadian taxes, US dividends face a 15% withholding tax on dividends from US stocks or US-based ETFs held in your TFSA. This is where strategic ETF selection becomes critical for maximizing your tax-free growth potential. For example, if you hold a US dividend stocks yielding 2% in your TFSA, you'll only receive 1.7% after the 15% withholding tax. Over 30 years, this difference compounds dramatically. However, capital gains from US stocks are completely tax-free in your TFSA, which is why growth-focused investing often works better than dividend strategies in this account. And really quick, I've noticed 80% of you who watch these videos haven't subscribed. An easy way to support this channel for free is to hit that subscribe button. It not only helps this channel grow, but lets me know you want to see more content like this. Now let's talk about the RRSP strategy and crucial details most Canadians miss. For 2025, the maximum RRSP contribution limit is $32,490 or 18% of your previous year's earned income, whichever is lower. The first benefit is that contributions are tax deductible, meaning that money you put in lowers your taxable income and reduces your current tax bill. The second benefit is tax deferred growth. Any gains from capital appreciation dividends or interest grow tax-free within this account until withdrawal, typically in retirement when you're in a lower tax bracket. Here's what many Canadians don't realize until it's too late though. You must stop contributing to your RRSP and convert it to a RRIF or purchase an annuity by December 31st of the year you turn 71. Miss this deadline and the entire value becomes taxable income in that year, potentially pushing you into the highest tax bracket. But here's the game changer that makes RRSPs incredibly powerful for US investments. Thanks to the tax treaty between the US and Canada, US dividends held in your RRSP won't face that 15% withholding tax like they do in your TFSA. This makes your RRSP the ideal place for US dividend paying investments. Now let me explain what happens after you convert to an RRIF, because this affects your retirement planning significantly. Once you convert your RRSP to an RRIF, you must withdraw minimum amounts each year based on your age. At age 65, you're required to withdraw 4% of your RRIF's value from the previous year end. At age 70, this increases to 5%. At age 71, it jumps to 5.28%, and at age 72, it's 5.4%. These percentages continue to increase each year until age 95, where you must withdraw 20% annually. These aren't suggestions, they're mandatory minimums. So if you don't withdraw enough, you'll face tax penalties. However, there are benefits to converting early. RRIF withdrawals starting at age 65 qualify for pension income splitting with your spouse, potentially reducing your family's overall tax burden. You can also claim up to $2,000 in pension income tax credits starting at age 65, which can eliminate some tax on RRIF withdrawals. Now here's the critical tax efficiency strategy financial advisors won't tell you. If you're making under $50,000 per year, you should generally hold off on contributing to your RRSP and focus solely on maxing out your TFSA first. Why? Because RRSP contribution rolls over indefinitely. So when you're earning more income down the line, let's say you're making $80,000 or $100,000, you can use all that accumulated RRSP contribution room to make a large contribution, potentially drop yourself into a lower tax bracket for that year. This strategy maximizes your tax deduction benefit when it's most valuable to you, rather than using it when you're already in a low tax bracket. And here's a pro tip. When you do make RRSP contributions, reinvest your tax refund immediately. This compound effect can add 20 to 30% more of your retirement savings over time. Now, this brings us to the two main approaches for building your portfolio: the lazy investor, one fund solution, versus the strategic 3 ETF approach. Let me break down both with real numbers and performance data, starting with the one fund approach, XEQT, managed by BlackRock. It's designed for investors who want hassle-free wealth building without constantly managing a portfolio. It includes 4 underlying ETF: XIC covering the Canadian market at 23.6%, ITOT for the US market at 47.5%, XEF for developed international markets at 23.9%, and XEC for emerging markets at 5%. This overall distribution is approximately 25% Canadian, 47% US, 25% international developed, and 5% emerging markets. With these percentages constantly adjusted by BlackRock through automatic rebalancing when any allocation drifts more than 10% from target. XEQT has a low expense ratio of 0.2% and has delivered strong average returns since 2019 inception. Though past performance does not guarantee future results, VEQT, Vanguard's all-equity portfolio, takes a similar approach but with slightly different allocations. It includes VCN for the Canadian market at 30%, VTI for the US market 47%, VIU for developed international markets at 16%, and VEE for emerging markets at 7%. VEQT has a slightly higher expense ratio of 0.24% but uses Vanguard's more conservative rebalancing approach, triggering rebalancing when any holdings drift more than 2% points from target. Using conservative 8 to 9% annual returns for long-term projections, which accounts for diversified global portfolios, including the Canadian market's historically lower returns compared to the US, investing $7,000 annually in either XEQT or VEQT for 30 years could potentially result in approximately $1.4 to $1.7 million. While both are excellent one-fund solutions, the choice often comes down to personal preference for BlackRock versus Vanguard management. And remember, these projections are based on historical averages, and past performance does not guarantee future results. Now, let me explain my preferred strategic 3 ETF approach, which uses 3 targeted ETFs for more control and potentially higher returns while maintaining that simplicity. First is VFV, the Vanguard S&P 500 Index ETF, which provides US market exposure and expense ratio of 0.09% and tracks the S&P 500. The top holdings include Apple, Microsoft, Amazon, Nvidia, and Alphabet. The company is driving the global economy. VFV is Canadian denominated, allowing you to avoid the 1 to 2% currency conversion fees associated with buying US listed ETFs directly. However, it does face the 15% withholding tax on US dividends when held in a TFSA. The second ETF is XIC, the iShares Core S&P TSX Cap Composite ETF, which gives you Canadian market exposure with an expense ratio of just 0.06% and provides exposure to Canadian financials, energy, and material sectors. Top holdings include Royal Bank of Canada, Toronto Dominion Bank, Shopify, Canadian National Railway, and Enbridge. XIC offers no withholding tax issues and provides important geographical geographical diversification. The third ETF is XEF, the iShares Core MSCI Total International Stock ETF, which covers developed international markets with an expense ratio of 0.26% and provides crucial diversification outside North America with exposure to companies like Nestle, Toyota, and Samsung. Here's where the strategic approach potentially outperforms the one fund solutions. My recommendation when you're getting started is 70% VFB, 15% XIC, and 15% XEF. This overweighs the US market, which has historically been my strongest performer, while maintaining meaningful Canadian and international diversification. The key advantage isn't necessarily higher returns, it's that flexibility. You can adjust allocations based on market conditions, rebalance during corrections, and potentially capture additional returns through strategic timing. Plus, you'll have a deeper understanding of what you own. For optimal tax efficiency, here's my account allocation strategy. In your TFSA, focus on VFV and growth-oriented ETFs that emphasize capital gains over dividends to minimize the impact of the 15% US withholding tax. This is where I hold my higher risk, higher reward investments since gains are completely tax-free. In your RRSP, hold VOO, the US listed S&P 500 instead of VFE because there's no 15% withholding tax thanks to the tax treaty. VOO has a lower expense ratio of 0.03% compared to VFE's 0.09%. This is ideal for US dividend paying investments and more conservative holdings. But you just have to consider currency conversion costs. If you can't access US dollars cheaply, VFE in your RRSP is still a great choice. Now, here's a currency conversion hack many people don't know about. Many brokers now offer USD denominated TFSA and RRSP accounts, allowing you to hold USD directly. Some investors use something called Norbert's Gambit, a strategy using cross-listed ETFs to convert Canadian to US dollars at minimal cost, potentially saving you the 1% to 2% in foreign exchange fees. When I first started investing, I focused 100% on maxing out my TFSA and began my 3 ETF strategy. I only started my RRSP contributions once I earned over $50,000 and had maxed out my TFSA. Now I max out both my TFSA at $7,000 and RRSP at up to $32,490 annually while maintaining 6 to 12 months of living expenses and liquid savings. I only considered non-registered investing after maxing my tax advantage accounts first. Now let me show you the real difference these strategies make using conservative projections. Starting at age 25 and contributing $7,000 annually to your TFSA with a conservative 8% return, you could potentially have $1.4 million after 30 years. With moderate 9% return, you could grow to $1.7 million. With an optimistic historical US market returns of 10%, you could potentially reach $2.1 million, though this level of sustained growth is not guaranteed. I always prefer to defer to the lower end of things. If you add your RRSP contributions starting at age 30, contributing $15,000 annually, your combined TFSA plus RRSP could potentially reach 3.5 to 4.5 million by age 65, all completely tax-free or tax-deferred growth. And remember, these projections are based on historical averages and actual results will vary. The beauty is that this isn't just the final numbers, it's the tax optimization and flexibility. Now, let me mention something most YouTubers won't talk about: estate planning implications. With your TFSA, you can designate beneficiaries who inherit the full value tax-free. It avoids probate if properly set up, and your spouse can inherit and maintain the tax-free status. With your RRSP or RRIF, it can roll over tax-free to a surviving spouse, but otherwise becomes taxable income to the estate. So proper beneficiary designations are crucial. There's also a US estate tax warning. If you hold significant US securities and your total estate exceeds $60,000 USD, including your principal residence, you could face US estate taxes. This affects fewer than 1% of Canadians, but it's worth knowing about for larger portfolios. Now let me share the most common costly mistake you need to avoid. First, don't try to time the market or panic sell during downturns. 2008 financial crisis, the COVID crash, and other major corrections all recovered completely for patient investors. Second, don't chase performance. Last year's best performing fund is rarely next year's winner. Stick to low cost, broadly diversified ETFs. Third is don't fall into analysis paralysis. Perfect is the enemy of good. Whether you choose XEQT, VEQT, or the 3 ETF approach, starting consistently is more important than having the perfect strategy. Fourth, don't ignore fees. A 2% management fee versus 0.2% might seem small, but over 30 years, it could cost you $300,000 or more than $500,000 on a portfolio. And you can calculate all your future profits using the free investment profit calculator in the description and first pin comment. And finally, automate out everything. Set up automatic contributions and dividend reinvestment to remove emotion and ensure consistency. For complete transparency, let me share my current personal allocation. In my TFSA, I hold about 25% in ETFs, primarily VFV for core US exposure, and 75% in individual stocks. 50% of those stocks are long-term holds for 5 or more years, and 25% are short-term positions. This is not what I recommend for most investors. And in my RRSP, I have similar growth-focused strategy using VOO instead of VFV with small position in dividend investments that I'm phasing out. And I'm focusing more on US listed securities to maximize the tax treaty benefits. Here's an important disclaimer. I spend 80 hours or more per week researching capital markets. If I didn't have this expertise and the time commitment, I would 100% stick to the 3 ETF approach or single fund solution like XEQT or VEQT. Individual stock picking requires significant time, knowledge, and emotional discipline that most investors just don't have. And here's your step-by-step action plan for 2025 and 2026, or basically whatever year you're watching this in. First, check your contribution room by logging into CRA My Account, but be aware of the current system delays or call 1-800-267-6999 if online information seems outdated. Keep detailed records of all the contributions and withdrawals. Second, choose your strategy if you're a beginner or want a hands-off approach. Start with XEQT or VEQT. If you're intermediate, use the 3 ETF approach with 70% VFV, 15% XIC, 15% XEF. Only consider individual stocks if you have significant time and expertise. Third, optimize your account allocation. Put growth-focused investments like VFV and growth stocks in your TFSA and US dividend investments or VOO in your RRSP if you can access US dollars cheaply. Only use non-registered accounts after maxing your tax advantage accounts out first. And fourth, automate out everything. Set up automatic monthly contributions, enable dividend reinvestment, and review and rebalance quarterly, not daily. Finally, stay the course. Ignore market noise and media hysteria. Continue contributing during market downturns through dollar cost averaging. And remember that time in the market beats timing the market. The wealth building formula is simple but not easy. Start early, contribute consistently, choose low cost, broadly diversified investments, and let compound interest work its magic. I didn't start optimizing my investments until my early 30s, and now at 39, my TFSA and RRSP are positioned for early retirement potential. Remember, it's never too late to start, but the sooner you begin, the more dramatic your results will be. The best investment strategy is the one you'll actually stick with for 20 to 30 years. Whether you choose XEQT, VEQT, or the 3 ETF approach, the most important factor is consistency and focusing on growth rather than trying to get rich quick. And based on historical data and tax optimization strategies, this approach gives you a strong probability of building significant wealth while maintaining the flexibility to adjust your strategy as markets and life circumstances evolve. However, remember that past performance doesn't guarantee future results, and these projections assume continued historical market performance. And remember, tax rules and contribution limits and investment regulations can change. So always verify current information with official government sources. Consider consulting with qualified financial professionals for advice specific to your situation. All right, now check out these 2 videos for more investing tips.